I welcome everyone to the Collateral Onboarding call number 33. My name is Juan. I'm the facilitator from SES, which is a Sustainable Ecosystem Scaling core unit. And today I'm with the people of Monachil, and I'm hoping that I'm pronouncing that properly. So Joseph, good. So Joseph and his team are going to tell us a little bit more about the project and answer any questions that we might have. So Joe, if you want to introduce yourself and tell us what this is about.
Great, I'll do just that. Thank you very much, Juan, and thank you everybody for giving us the time to present today. A presentation will have been circulated, but to kick off and do the introduction, I'll just freeform that, and all the information will be contained in the presentation. And then when we start talking specifically about the topic at hand, we'll move to the pages that we prepared for this. So background is Ali Melli, who is here with us, as you can see, founded Monachil Capital in 2019. The fund was launched August of 2020, August 10th of 2020. Ali and I spent the better part of 17 years working together at Goldman Sachs, and so very happy to have the opportunity to join him here. During our time at Goldman Sachs, we'll spend a lot of time going over that, but just as a little bit of background, because it does speak to what it is we're doing now at Monachil. But during our time, amongst the various things we did in structured credit space, one of the significant opportunities that we found was in our structured lending business. And that was a business that we grew. I ran the business in London for a number of years. Ali has run it in different locations and ran it globally before he left as partner in 2019. What we learned, and so it's that experience in our structured lending space that Ali has transported here. What we did when we were at Goldman, sort of varied depending on what the market was, meaning the underlying assets varied. What was consistent is we typically lent against relatively illiquid assets, with our approach being that, with the right risk management framework, we could value the assets and ensure that, we were executing and the right lending transactions and we're protecting our downside risk. Though the asset class has now migrated, now that we have moved to Monachil, the idea is exactly the same. The way that the asset class has migrated is the opportunity set we're seeing now in the market is that banks are increasingly being disintermediated by tech platforms which are lending directly. Those tech platforms, though they often have very high quality tech and excellent underwriting standards, what they don't have is access to sort of traditional banks to fund themselves, which is where we step in. Our perspective on this is, and our angle compared to others who are in the space, and there are others who are in the space, is that we approach this with the same risk management hat that we always wore when we were at Goldman, which is by having the understanding the platform, understanding the borrowers to that platform, and having the right data, we can quickly react to the extent that we see any issues with our lending profile. So what we have done is we developed a proprietary technology which allows us to interface directly with any of our borrowers. And by doing that, it lets us do a couple of things. Number one is for the due diligence process, we can consume real data from their underlying borrowers so that we can verify it ourselves. And then for this basically the small handful, 5 to 10% that make it past our due diligence, and we actually transact with, it allows us to consume that data on a real-time basis as a means for surveillance of the transaction. What that does for us is a few things. Two of them I'll touch upon. Importantly, it allows us to create reporting to see how each of the platforms are doing with vis-a-vis the covenants that we have agreed in the contract that we will have entered with them. And by having visibility not only on whether or not a covenant has been breached, but whether or not performance versus a covenant is beginning to deteriorate, it allows us to act very quickly with our clients, to either grab more security to make sure that we're protecting our downside risk in that case, and at the limit, which because we have the right, we don't expect to need to do, to foreclose if we needed to, and to simply take the assets and manage them or liquidate them ourselves. All of those transactions are executed with a haircut. So our advance rate is somewhere between sort of 60 and 80%, depending on what the transaction is, and each of them sort of fits that profile. The second thing, that allows us to do is it allows us to have a view of each of our clients' business model, and to the extent that they are approaching, we tend to be their larger or the largest lender to them, and to the extent that they are breaching covenants or coming close to breaching covenants for reasons that we think are structural in their nature, whether it's your asset liability mix or their accounting standards, it gives us the ability to have influence over the way that their business models are managed. And we have a couple of real world examples of how that has happened. We should probably save that for another time or at the end. But that's kind of the background on Monachil. And so where we are now is we, as mentioned, we have, as is in the presentation, we have, $17 million in commitments. We have $11 million, which we have put to work. We're very much in fundraising mode at the moment. Our performance has been relatively good, so we feel optimistic right now about our ability to raise capital, which brings us to sort of this proposition, which we're discussing, which we think will not only enhance our sort of abilities and our returns, but it is something that sort of knowing your objectives as well, be something that we can will grow with as the fund grows. So with that said, I'm going to turn it over to Ali to talk specifically about the proposition in our MIP6.
Thank you, Joe. So really what we are aiming for in our MIP6 is a credit facility backed by assets of the fund. The structure that we have put forward is what I call low LTV loan. Initially it's at 40%, or if you look at over collateralization, 250% over collateralization. That's the value of assets of the fund versus the amount of draw that we are getting from Maker. So the idea is that effectively, if you have $20 million worth of assets, you get 8 million dies against those assets. That's the basic proposition. The valuation of assets themselves, the assets themselves are custodied by a third party, which is SS&C. They are our fund administrator. Their function is really to make sure that assets that we say we are holding are actually owned by the fund, and the payments are processed accordingly. They essentially do all of those operational steps to make sure that the fund is performing as expected. And they are the biggest fund administrator in the world, or one of the biggest fund administrators in the world, given their technology platform. In order to achieve the transaction with Maker, our proposition is to partner with Centrifuge, create tokens that represent effectively the loans to the fund entity, and then have a lender SPV, which on one hand is going to hold those tokens, and then on the other side is going to borrow versus those tokens from the Maker. I'd like to pause here and see if there are any questions, or if there are anything that maybe Jason or the team likes to add.
I have a question. This has to do with the evaluation of your assets, what we're financing. Who does the evaluation?
So the valuation is performed by SS&C. They provide essentially the valuation statement, and then on top of that, we go through an audit process. So we have hired Ernst & Young to do our annual audit, but the valuation of the assets on a more regular basis, what I call unaudited numbers, the source of that is SS&C as the fund administrator. And that has some value because independent from us, they verify the cash. If we say our investment is a loan that has a coupon of X, they make sure that actually that loan is performing. It matches the cash that is showing up in the bank accounts. And not to get into the very nitty-gritty, we actually don't even have control over the bank accounts of the fund. Anything that needs to be happening on the bank accounts of the fund goes through the fund administrator or SS&C. And that gives two levels of protection. One of them is making sure assets of the fund go where they are supposed to. The other one is because they see any cash movement, they can make sure that the valuation matches, the cash movements in and out of bank accounts.
All right. This finance, is it usually provided on a revolving basis, or is it a kind of a one-time offer?
We think it is a revolving basis for two reasons. One of them is as assets of the fund grow, or essentially is function of availability of assets of the funds. So for that reason, it's on revolving basis, and it works on both ways as well. If valuation comes down, i.e., if for some reason SS&C goes and says next month the value of your assets is less than what it was previous month, it will then we have an obligation to repay. So for that reason, it's a little bit of it has a little bit of a revolving feature.
Let me just make one more point to that, Ali. So the way that it's our preference and to execute these transactions such that we provide each of these platforms with a revolving with revolving financing. The reason we do that is because at the point in time that we're doing it, if we have gotten to execution, it means we're locking in a level which we think is attractive for us and attractive for them, and so therefore locking that in for a longer term basis is interesting for that reason. It's also interesting to us because in each of the cases, though this varies by how much between transactions, the underlying transactions that are collateralizing our line of credit to the platform tend to be shorter dated. So those assets, the underlying assets, they come due and then they're sort of loaned out again. What that does is it gives us a lot of visibility of the performance of the platform and their borrowers, which then allows us, to choose our behavior as we're doing business with them. Which, if they're not performing well, we can, begin enforcing some of our covenants and sort of grabbing more security. To the extent they are performing well, we may choose to upsize with them. And in each of the transactions we've done, we have the ability to upsize.
So the time frame we're talking about is like 90 days or a year. So what we're talking about here?
I mean, it varies. Ali, why don't you
sorry, the time frame for what aspect exactly?
The underlying assets, I think, is what we're being asked. So we're lending for 4 to 5 years to each of our platforms, and the underlying assets. I mean, why don't you kind of give the range that those tend to occupy?
Yeah. Okay. 4 or 5 years. Okay, that's quite long. Yep. All right. Thank you.
Yeah. And now in terms of what frequency of the data that we collect is daily. Like on one hand, we could put money to work for 4 and 5 years. But for example, we have one of the transactions that we have in our portfolio is a pool of auto loans. The auto loans themselves are, on average, they have 3 years life left in their life. However, we get cash flow reports on a daily basis of what portion of people have paid on time, what portion of people are falling behind, what's the speed of collections. And that information that you get on a daily basis informs you a lot. It was actually very helpful for us during, the pandemic to have that information, because we were seeing that the performance is actually holding up fairly well. And we actually kept upsizing that, and it now matches the data because now essentially prices for used vehicles are higher. Even though that wasn't an insight that we had in time where we were making those decisions, we were able to infer that from the payment information that we're getting on a daily basis. And I think that's what we think is essentially in one of the most important ingredients in our own investment process, looking at that type of data on a daily basis, deciding whether we want to have something amortized, which if a covenant breaches, or if something bad happens, we have the right to essentially start enforcing on the day off. And on the other side, if things are going well, which is our hope, then we can keep the transactions in place for up to their maturity.
And Ali, what for the auto loan transaction, what's the weighted average life of those 3-year loans?
So weighted, it actually varies vintage by vintage. Weighted average life turns out to be around a little bit more than 18 months.
Yeah.
But
which I think is an important point, right? So it's sort of 18 months for auto loans, and for some of the other facilities that we've done, it could be as short as 3 months. So we do get to see quite a bit of turnover during that 4 to 5 year period that we've committed the loan for. But sorry, Ali, you were going to make another point.
I was going to say something along the same lines, which is when we want to look at assets that are uncorrelated, you end up with shorter dated stuff. Like on the shorter end stuff, we have some loans that have a maturity of 1 month. Essentially, they are short-term loans. On the other side, monitoring them is obviously more intensive. So we have a variety of underlying assets, but even the credit that we extend to the originators of those assets tend to be longer dated.
Okay. Any other questions before Ali presses ahead?
I'd say maybe while we're on this topic of the length of the loans, maybe talk about the length of the senior credit facility, how we're structuring that piece as well between Monachil.
Yeah, that's a good idea.
Lender SPV.
Sure. So let's just talk a little bit about lender SPV, because Monachil, as well as our payment processors, use fiat currency. They see the world in terms of dollars, not DAI. So that lender SPV essentially is doing that transformation of DAI to dollars for them. In terms of the tenor of the loan that is being extended from that, it has a final maturity of 5 years. And then in terms of frequency for interest payments, it's a monthly pay instrument, because again, we think it's important for facilities of this nature to have frequent payment terms. It also, obviously, you see during that time, it's not a one and done thing. It's not just that it needs to be 40% LTV during the life. 40% LTV needs to be maintained, provided that if it is not for some reason maintained, then the cash flows from the assets will be used to deliver the loan so that it comes back to compliance. I know, Jason, if that was responsive to your question, or if you want me to go into more detail.
No, that's perfect. Just wanted to set the stage that the maker is committing to this proposal is asking maker to commit to a 5-year term for this loan.
Yep. Okay. You can keep going, Ali.
I think that pretty much that's it. Essentially, the structure itself is fairly simple. I think it's already highlighted in our MIP6. The credit facility agreement that lender SPV will be entering between our funds, which is Master Fund 1 and Master Fund 2, is going to be have a corresponding non-fungible token, and then the NFT itself is which represents the loans are going to be supported or going to be created, are going to be used for creating the tin and drop tranches using essentially tin lake service agreement with Centrifuge. And the other thing that might be relevant in the construct, if people have questions, is why is there Master Fund 1 and Master Fund 2? The answer is due to different tax treatment for limited partners that are investors in our fund. We went and set up two separate entities to hold the investment. So one entity holds investments that represents active income in the US, and the other entity represents investments that represents passive income. But that's more something that impacts our limited partners, doesn't have that much of an impact on lender SPV or maker.
Yeah, they're fully pari passu basis. Great. Okay. Any other questions on what we've covered so far? I'm just flipping through the presentation. I think we touched upon the relevant points.
Can I ask again?
Sure.
Just taking a quick look at your application here. You are providing capital to some somewhat risky entities. Am I correct that your biggest risk is your counterparty risk, they going down?
No, that's a very good question. So thank you for asking that. And that's the way that we have set this up is, so we actually don't have risk to our counterparty going down. So what we have risk is to the assets which have been pledged or sold to us under the terms of our transaction, so our collateral. So the way that is done is that collateral is sold to us on a, we own it on a true sale basis. And so to the extent that our counterparty didn't perform, or the underlying assets which the counterparty is using for the performance of this begins to fail, we can immediately foreclose. We can begin trapping more cash and ultimately foreclose on the assets. So the performance of the underlying assets is our risk, which is back to the kind of the earlier point that I opened this up with, which is the way that we have set this fund up, which we think gives us a relative edge in this space, is our platform, our data system interfaces directly with each of our borrowers, platforms, so we can consume real-time data from their underlying borrowers. We have sort of real-time visibility on the performance of the underlying portfolio. So if there's anything we do need to do, we can act quickly and again, whether that's sort of diverting cash flows or foreclosing on assets. We don't expect to have to foreclose at any point, but having that stick available means is probably the biggest reason we won't have to, because it's very clear in our contract that we could.
Okay, thank you. That clears things up. Okay, I have no more questions right now.
Okay.
Oh yeah, I have more questions. This is about your legal structure.
Yep.
It is slightly complex. So first of all, I'll say thank you for just making us aware it is complex. But you have a number of Monachil companies. Where do we start?
Sure. Ali, you want to do the rundown of how and why we set up Monachil the way that we have?
Sure. So I guess the question is, before I go over Monachil's legal structure, I want to understand the questions correctly, which is
okay,
around the structure of the loan or the structure of the fund?
No. Okay. The thing is, don't go into details about the setup, because it will be too complex to cover in one meeting.
Okay.
Yeah. But just an overview. Why is it split into so many companies?
Sure. So on our side, it is mainly that it's really interest of our LPs. So to the extent that we have LPs our investors in our funds that are not US taxpayers, they do not want to have to deal with hassle of filing tax returns with IRS. On the other side, they have an obligation to pay their taxes in US. So the way we solve that is by setting up a corporation in US where that corporation acts as a blocker, which means that they do make the tax filing, they pay taxes to IRS, and then the offshore investors receive a dividend from that corporation. That's essentially the proper form for offshore investors like that want to pay their taxes in US, but they don't want to have their own accountant do their tax filing for them. That's how they achieve that goal. So for you, for example, look at our structure for an offshore investors, there is a payment fund that puts that money into US corporation. US corporation pays taxes in the US, and then that US corporation gives that money to our master fund, then makes the investment. The purpose of that is to achieve compliance with US tax, essentially laws, and at the same time not to create operational burden for someone who might be an investor sitting in United Kingdom or European Union who wants to be an investor in the fund. And then for US investors, their structure is somewhat similar. They don't need to worry about having a corporation that pays taxes because they anyway have to pay taxes in the US. So the way they need to report their income is going to be slightly different. And hence, depending on these two different classes of limited partners in the fund, we had different entities. And we also keep track of our investments for that matter. Some investments that we make, they are just like investing in a bond or pool of loans. There is really not that much of a tax liability associated with those investments, because if you're a bondholder, even if you are an EU person holding essentially bonds of a US company, you don't have to really worry about paying taxes. There is a particular exemption from having to pay taxes called portfolio exemption. On the other side, if the nature of investment is active, which for most of our investment it's active. Reason it is active is because we are going to be structuring the transaction. We are viewed as having an active role, and by that construct, we need to make sure that people who invest money in our fund as limited partners are not viewed as actively engaging trade or business. The way we achieve that is by putting those investments in a separate entity, which in our case is Master Fund 2. And then Master Fund 2, any income that is generated from Master Fund, we pay US taxes on behalf of the investors, so investors don't need to worry about that. And one day, what they receive is going to be after tax income.
All right, thank you.
Sure.
Anybody else?
I think we can move to the presentation now.
Well, that was kind of it, Juan. I think we've walked through the
Okay. I thought you had like some slides or something.
No. So we sent some slides, which would mostly as a takeaway, because I know that this will sort of the slides will remain available. So they basically say the same things that we went through. It gives background, investment strategy for Monachil, which I went through, and then it talks in more detail about the sort of the MIPSIPS application, which Ali just went through.
Sounds great. I don't know if we have covered the volumes that we would be looking at.
Sorry, that's a very good point. Yep. Yeah, Ali, why don't you take that? That's very good.
Our proposal is to start with an 8 million DAI line, and then as the fund grows, we expect the facility to grow, and we will probably come back with asking for upsizing. But in terms of the scalability, we think it definitely is something that can be scaled up to tens of millions of DAI, if not more than that. And again, our philosophy is to start with something that is sizable, but maybe on the smaller end of the spectrum, making sure we build all of those connectivity, the technology works, we can build all the connections between SS&C in terms of getting independent valuation flowing through the system. And then once that, all of that is working, our hope is really to upsize the facility to a much more scalable number, because obviously this requires some type of time and effort by both sides. And we think it's, I mean, the Team Lake technology and the whole structure, I think is something that if we find the right mousetrap, I think it can be scaled up fairly well and fairly easily.
I have a quick question. Sorry about the noise. I'm having some trees removed. So just to build on what you just said, how many months do you think it would take you to deploy, consistently deploy 100 million into the market?
How many months it would take us? I think again, with the whole thing that forward-looking statements are, by their nature.
Understood.
But we think that essentially, like, we already have a big pipeline. We think over 12 months, it will be possible to deploy that, if not even sooner, to get to that scale. But it's a little bit of it's going to be a function of our fundraising, because we also need to make sure that we have LP. We have a very good pipeline. We have shown that our pipeline can generate returns, but we also need to then raise LP capital and make sure that as we are drawing from essentially our, we are drawing DAI from the maker, there is enough LP capital in there so that we can meet the over collateralization requirements.
Yeah, I mean just to put a finer point on that, we're at a number approaching, $20 million of committed capital, and our goal is within the next 12 months for that to reach $100 million in committed capital. And as Ali said, we have sort of a pipeline to put that to work when we get that in the door.
Awesome. Yeah, because I think that the scalability is top of mind for a lot of maker holders right now, because I'm not sure anyone's explaining to you, but we have about $3 billion that we need to refinance out of an asset that's currently producing nothing for us. So yeah, I think we're all looking forward to getting you into the system.
Got it. No, that's it. Understood.
On a separate topic, could you guys talk about delinquencies and defaults? If you were to be delinquent or default, what would Maker's solution be for that?
Sure. So we expect Maker be viewed as a essentially secured creditor. When we put the legal structures, there will be UCC filing, making sure that the lender SPV is viewed as a secured creditor to Master Fund 1 and Master Fund 2. So the first stage is we are assuming that some basics of structured finance. We're assuming that lender SPV will act on behalf of the maker community. Theoretically, it's possible that somebody in the SPV doesn't do what they are supposed to do. Then you can sue the directors of the SPV, because they are supposed to act in the best interest of the lender to the SPV. So that's how you can ensure that the lender SPV acts in the best interest of makers, which, I mean, it's a structure that has been tried and tested many times in a structured finance. That part of it people take trivial, but obviously I understand if people have questions about that. It has been, that part of it is the easy part. The part of it that requires real action in the court is if payments are not happening. Suppose there is an interest payment to do, or there is some cash flow due, which is not happening. You need to essentially get a judgment against the borrower, which should be Master Fund 1 and Master Fund 2, and inform essentially SS&C as the fund administrator that there is a dispute or there is a potential event of default. That kind of puts a freeze in funds leaving, and then the courts will enforce your rights. And again, the important part is because is existence of SS&C as an independent third party, that their reputation and business is very important to them. So we don't expect them to do anything untoward. They need to represent interest of people that are independent from us as the asset manager. They need to represent it, and they need to have a balance.
Yeah, and look, for SS&C, this is what they do for a living, this type of fund administration. So they're used to, I mean, it does just happen. They're used to getting notice of a potential event of default and sort of freezing what it is that they're holding for the benefit of the secured, which in this case would be the maker community.
Are you planning to forgo a so-called tin tranche with centrifuge?
It's a very good question. So our understanding, that's a little bit of maybe Jason question as well. Our understanding is to make the tin leg protocol work, we still need to have a tin tranche per se, albeit it's nominal in nature. And then even though the real equity is the equity that is not represented by tin. Our real equity is what is held in the funds, is held by SS&C. That's where the 250% over collateralization comes from. But there will be a tin tranche, because from what I understand from, and Jason is the expert, to make the centrifuge in lake protocol work, we have the tin tranche.
Yeah, but the function of the tin is dealt with in the over collateralization, which is very important for everybody to understand.
All right. So what you're saying is that because you are already over collateralized on your side, you are not planning to use the tin tranche at centrifuge.
It's actually it's slightly different than that. I think is because the maker community will be over collateralized in what's right by there's 250% over collateralization. So because this transaction would be over collateralized, that is performing the function that a tin tranche normally would in what you would, I assume you would consider sort of a customary executed transaction.
Yeah, maybe I could jump in a little bit here. Okay, so we looked at this deal, and their funds have traditional LPs, traditional investors that are fiat investors that are investing in their funds. To have those LPs run through Tin Lake is not really realistic. They're institutional investors that are not in the crypto world at all. So we had this issue. We had this off-chain fund that is protected by that does have a fund administration, that does provide a monthly NAV, that does get audited on an annual basis. But we said, how can we get this off-chain equity and provide an on-chain warehouse line or senior line for this fund? And that was the challenge. The way and the other part is that for centrifuge, the drop is the solution that is the adapter that works with Maker. So we felt the best way to do this is we create a drop layer, which is on chain, that goes into Maker Vault. But instead of taking the traditional tin tranche, which would be on chain for the junior tranche, we'll just use the fund off chain as the junior tranche. In order to make that work, we have to do a slight hack. We have to make 1% of the total pool in tin. So we have 99% in drop, 1% in tin, and then we have this large off-chain equity component, which really acts as the collateral in this case for the maker.
All right. So instead of tin, you have off-chain collateral. Why not just use tin on centrifuge? Why doesn't that work?
Again, that would require all of their LPs in their fund that are traditional LPs to convert to crypto and invest in DAI and invest in the fund.
I hear you.
Yeah, perhaps that could happen someday, but realistically, if they're talking pension funds and endowments and such, it's not going to happen today.
All right. So the customers on centrifuge, they are typically not interested in tin tokens from you guys. Is that the rationale? Did it sound right? Yeah.
Is the question addressed to us or to Jason?
Yeah. Jason has his microphone turned off. There.
Okay, I mean, I can try and address it again.
Yeah.
Yes, that's correct. If we're talking a traditional institutional investor who does not know crypto at all,
Yeah.
they do not have interest in purchasing the tin today. Perhaps in the future, we'll get to the point where institutional investors will look at investing in a crypto on-chain fund equally to investing in a fiat fund. But for today, realistically, the LPs into the Monachil fund will be off-chain investors, traditional fiat investors investing in a traditional fund, won't touch crypto in any way. That's happening today. And instead, Monachil will work with Maker to tap a line of credit from Maker.
Okay. I'm just curious to why this that piece of mechanic was in place. I can see where you're coming from. All right. Fine. I have no further questions right now.
I just wanted to maybe add one clarification. It's not directly related to this question, but just one comment that I wanted to make, which is when we talk about 250% over collateralization, that's vis-a-vis the money that we have put out. So if we ourselves are lending, let's say at 70% LTV or 140% over collateralization, suppose essentially think of the following example. If we lend $100 million against something that is worth $140 million, then the 40% will be 40 against 100. It is not 40% of 140 million. It is 40% of 100. So we are not really, when we say 250% over collateralization, it's not over collateralization versus underlying assets. It's a more conservative and we think appropriate measure of over collateralization, which is over collateralization versus amount of money that we have put out or amount of our assets, even if our assets are backed by assets that are worth even more.
So just to simplify what you said, Ali, when we're talking about the loan from the Maker community, it's 40 million. In your example, it's $40 million against an asset worth $140 million.
Yeah, the total assets is 140. Now
Yes,
our claim
exactly.
over those assets is $100 million claim.
Yep.
And then essentially Maker's claim against our $100 million worth of assets is 40.
Yep. Yep.
So you have 40 million exposed on 140 million in assets.
Exactly.
Yep.
I'm wondering how the what we call the oracles work, right? So how do we know the price of these assets? Is it by these audits that you were mentioning, or how does the whole process work?
Sure, those prices will be provided by SS&C through the monthly NAV. We have an obligation to make sure that those NAV is essentially calculations are available. And then they get audited by Ernst & Young on an annual basis to make sure that what is provided as a NAV is essentially passes accounting muster as well.
And let's say that I don't know, there's a covenant breached or any type of thing that's not liked by the Maker holders. And how would the process work? Any type of liquidations or any type of
So it depends on what type of events of default are. We generally expect in these type of facilities to have two things. One of them is if certain things are not complied, the initial remedy for that is cash trap, i.e. all the incomes that are generated by the underlying assets will be diverted to pay the drop tranche and essentially will go to the secured lender. That's the typical structure that we see in the market. CLOs are a great example of that. If essentially you see a bunch of defaults on the underlying loans, what will be happening is that cash flow gets diverted so that the senior tranche gets deleveraged. And then if there are more kind of serious things happening, like payments not happening and not making a payment, that's the more severe thing, consequence of hard event of default. And for legal enforcement, you can essentially enforce a judgment, get a judgment. Your rights are protected as a secured creditor, and there will be a UCC filing, which is effectively equivalent of registering your collateral with the court system. When before essentially we enter into the transaction, your collateral will be registered with the court system, so it's clear that the collateral belongs to the senior creditors.
And would that process be initiated by you or by maker? How would that work? Is there like a designated
part of the legal, like at the point where we have the credit agreement in place? I think the way these things are done, these are set up on day one. You actually don't want to wait till the moment the bad events happening to try to register the collateral. The registration of collateral, which is done through a filing with UCC, we expect to be done by the counsel that represents the lender SPV, and whichever counsel is chosen to do that work will be done upfront. It will essentially be a conditioned precedent to us receiving money. And again, that's market structure. Market standard is before you give someone money, be that aircraft securitization, be that CLO securitization, you want to make sure that they have perfected the security interest and they have done all the necessary filings, so that if at some point in the future something bad happens, it's very clear collateral belongs to her. And that's why the system works and bad things rarely happen, because essentially touching someone else's collateral when they are a secured creditor in an insolvency proceeding carries criminal liability, carries all sorts of liability for people.
Yeah, and so the point you made, I think, is an important one, Ali. That all this is pre-wired on day one, right? And so what that means practically then is, to the extent that there's an event of default, is you notify the notify SS&C, so the administrator, that there is potential event of default, and then the rest of the process just happens as it was wired on day one.
Yeah, maybe I'm not well informed enough or smart enough to understand the whole deal. So I was more wondering if things go bad, and I understand that things are going to be set in day one, hopefully in the proper way. But if things go bad, how is the process initiated? What recourses does maker have to actually start redeeming this? What it's potentially, well, not necessarily bad debt, but what could become bad debt if things go really, really bad, right?
Ali, why don't you give sort of a practical rundown on kind of how that works?
Sure.
Sort of, I mean, like very specifically what the actions that would have to be taken at that point in time. So I think they're pretty straightforward.
Sure. So there is essentially two things that you need to keep in mind. One of them is how people are expected to react. The other one is what happens if people don't react the way they are, or they don't perform the obligations that they are supposed to perform. And usually the second component, which is bad things that could happen to people if they don't perform the obligations that they have, is what gets them to comply. So we expect if bad things happening, let's say the bad thing that has happened is 1 month interest is missed. So there is a payment that is owned by the borrowers, Master Fund 1 and Master Fund 2, that is supposed to come to lender SPV. If that payment is missed, the first thing that lender SPV will do is to make a claim and ask for a judgment, essentially to make the payment happen. If then two things could happen. Either the entities are insolvent or they are solvent. If they are solvent, at that point in time, the court will side with lender SPV. There is one underlying question, is that who would do that filing on behalf of the lender SPV. The board is of that SPV is supposed to be the fiduciary and take those actions. Now, if the board doesn't do that, for some reason, suppose the board members don't behave, they do the way they are supposed to, then they have personal liability. They can get sued as in their individual capacity.
But I think, but the real world example, I mean, I understand that, but I mean, that's really an outlier. I mean, that would be a far outlier, I think, for anything that you and I have seen. I think, sort of the base case is that it becomes the board's responsibility to sort of, to file and to follow up, right?
Yeah, to file. And then if the entities haven't filed for the entities being Master Fund 1 and Master Fund 2 haven't filed for bankruptcy protection, then they're supposed to make the payment. Someone gets a judgment, they make the payment. If they, at some point, they file for insolvency for some reason, then that's where the UCC filings and registering the collateral becomes important. Because at that point in time, that is what gives essentially the lender SPV the right to go and say that, okay, even though there is a bankruptcy proceeding, I'm secured by these assets, all cash flows, income, everything corresponding to these assets is really my property. And then anyone, any LP in the fund, anyone that other creditors of the fund, they should really wait and sit behind me and wait for me being the lender SPV till I get fully paid.
Here's the thing again with the lack of tin, because if this was structured as a bunch of drop and a bit of tin on top of that, the first hit would be taken by the tin holders. But in this case, it's not applicable. So my question is, if we do not have tin, but we have external funds, and there for some reason there's a problem, all right, then at what priority would maker have in the bankruptcy proceedings?
Very good question. You'll be senior to the LPs of the fund, because the LPs of the fund, or what we call the off-chain equity, their ownership interest is through the ownership in Master Fund 1 and Master Fund 2. Now, if assets of Master Fund 1 and Master Fund 2 are essentially pledged or registered as security backing the loan that the lender SPV is making to Master Fund 1 and Master Fund 2, it means that essentially the first priority and all the income goes to the lender SPV, which really represents the maker, or represents the drop.
Which importantly, Ali, implies that and to your point, the first hit is taken by Master Fund 1 and 2, right? So they're taking the first hit because lender SPV is senior to them for those pledged assets.
And that's how accountants and everyone also recognize. I mean, suppose it's not even a bad event. Valuation of assets could change. Some, I don't know, like if assets are not dollar denominated, the value, the FX rate could change. There could be some minor fluctuations, major fluctuations, whatever happens. The first layer of that P&L hit or change in NPV or change in NAV is always borne by the LP. They are all, even on an accounting front, they always take the first loss hit, the same way that it would have worked if there was a team involved.
All right. So can I ask, how do you arrange for the various liquidity providers or the off-chain capital? What kind of ranking order do they have with regards to taking the hit?
They are pari passu. I mean, as much as our structure is complex, it is actually fairly simple. Everyone is pari passu. All those LPs, etc., they are treated the same way. The structure is designed so that everyone gets the same treatment. The only difference for having these different boxes are really like making sure that their tax filing doesn't become complicated. But it's not as if one LP is more senior than the other LP.
Yeah, and it's probably a good place to note that the structure that we use for the funds is actually pretty standard. It's complicated, but we didn't invent it for the purposes of our fund. This is used by by others. Yep.
Just wondering how you're doing it. Okay. No more questions right now.
I guess I have one then. How frequently would we be able to see the value of the fund? Like, is that something that's reported on a monthly basis or ongoing?
Yeah, it's available from SS&C on a monthly basis, and then it is we obviously for our own purposes we calculate it on a daily basis, but the SS&C numbers are available on a monthly basis,
and then audited on an annual basis.
And is
guys,
there
if
any?
we put, sorry,
Go ahead.
No, go ahead, Pete. I'm sorry.
I was just going to ask if, like, let's say, like, if the fund experiences a significant percentage drop, or like, is there a notification that has to take place? Like, let's say you during your daily updates, you've noticed it's dropped X% since the last month update. Is there a notification requirement in terms of letting Maker know about that in between monthly filings? Sorry.
we are open to that. I don't think it's something that has been explicitly addressed.
Yeah, I think what so there'll be documentation between the master funds and lender SPV, and we would expect those type of requirements to be captured in that documentation, and then that would create the obligation of the terms of this transaction if it were to be there.
Makes sense. Thank you.
That was a good question, and this is kind of just a follow up to that, which is we've all the kind of the minor parameters or rules that go into constructing the portfolio. Let's say no more than X% can be in one asset originator, or no more than Y% can be in a certain geography, whatever they may be. We've started kind of forming those rules, and we'll work with Will on the real world asset risk team to establish those. But are those tracked by SS&C? So will they, when they provide their monthly update, will they also check all of the rules that we set in place and verify that you are within the parameters that we set forth?
As of now, essentially the LPs are the people that are most concerned about them. This is so standard. Essentially you are not expected to even violate that, and so hence there has not been that much report. I mean, it's an obligation. That being said, we are happy to provide those reports and share them with SS&C so that they can independently verify and share that with people. But honestly, it has not been a thing because it's so standard that if you have portfolio requirement, you stay within your portfolio requirement.
Are there any parting questions before we close the call? We're already at the top of the hour. All right. Yeah, so Joe and Adi and team, I wanted to thank you for coming and giving us your time. Where can people find you and ask you more questions if they are seeing this later in the recording?
We can circulate our details. You call us we're usually all together in the office in Greenwich. We can circulate our details. You can give us anybody can give us a ring or send us an email if they have any follow-ups. Sounds good. Let's keep the discussion going in the forum.maker.com. Thank you everyone for coming. Have a nice one. Thank you very much for your time, everybody. There was lots of great questions. That was good stuff. Thank you. Thanks.
Thanks. Bye.